Today we're talking about how much house can you afford with a $75,000 income. Hey guys, Dan from Pekoe.ca. So a follow-up to my other video where I talked about the unaffordability of downtown Toronto and what it takes to, as far as income goes, in order to afford the average price. And if you guys haven't checked out that video, I will leave a link somewhere to it so you can watch that one. It's a little surprising to see what you have to make overall in order to afford the average house in Toronto. But I wanted to do a follow-up and look at the other side of that coin, and talk a bit about what you can afford with lower income. So basically, let's just jump right into it. So we're going to make some assumptions that I talked about in my last video, mainly based on the average Canadian household debt. So this was pegged at $23,000 a person. That works out to $690 carrying costs a month. And keep this in mind, it's really important that we address that. So it's not a one-to-one when it comes to how much mortgage can you afford. So for example, if you paid off $23,000 in debt, does that open up $23,000 in new mortgage? No, actually, it does better. It really does help out in paying off some of that unsecured debt if you can, partially or altogether. So let's take a look at it, guys. When we're talking about a $75,000 household income on an application, we're typically talking under $1 million purchase price. You're not going to have a huge down payment. We're going to focus on two different ones. Your insured mortgages, so that's your mortgage where you're putting less than 20% down. And for this assumption, let's just assume 5%. And the other one would be a 20% down payment. And the reason I'm looking at two different scenarios here is because we have to qualify you based on two different sort of criteria. So insured mortgages, very strict with those debt ratios, so we can't exceed those. We also have to use a shorter amortization, so we can't use a 30-year amortization on the stress test. We actually have to use 25. Also, we have to include the mortgage insurance as part of the overall debt ratio. So that factors into reducing your affordability. And then if we look at a 20% down purchase, so you've got that 20% down payment, we can avoid that insurance. And we've got a few different options there. We can open up the amortization to 30 years, so it stretches out your payments an extra 5 years, helps with that affordability. And then we can look at alternative lending too. So these are your, you may have heard the term B banks, but they like to be called alternative banks, where they can increase your affordability by being able to stretch those debt ratios. So let's jump into it and take a look first. Do you want the good news or the bad news? I guess what we'll do is we'll jump into the 5%. So let's assume 5% down payment. So you're talking with an insured mortgage here. Your maximum, if we just keep that $23,000 debt intact and we don't touch it, it's $315,000 purchase price, and that works out to a 5% down payment of $15,750. Keep in mind this doesn't include your closing costs, so you want to budget about 1.5% and set that aside for your closing costs. So those are your legal fees, your land transfer tax, anything else that might come up. So that's if you keep that $23,000 debt. What happens if you decide to pay it off? Well, definitely works in your favor. If you pay off your debt, that increases to $355,000 of a purchase price, 5% down. 5% down is a couple $1,000s more. You might see my cat back here. One of the joys of working from home is that, they just decide to come on set. Not your time yet. His name's Potato. Anyway, okay, so 5% down, and you might think, well, what am I going to get for $315,000 or $355,000? I just did a quick check on MLS, and you'd be surprised if you can move around. If your work allows you to work remotely, there are quite a few properties that have come up for less than even $315,000. So take a look there, see if that's something you could do. So let's jump into the 20% down now. So this is when you've got at least 20%, so we can avoid that CMHC or say June or Canada Guarantee Insurance. So if we assume that you keep your debt, you've got a maximum ceiling of about $400,000 and an $80,000 down payment. Okay, guys. So 400,000, you're getting a lot more, and really it just comes down to being able to stretch that amortization to 30 years and not have to include that mortgage insurance in your payment. So it moves the needle up a little bit. Now, if you end up paying off that debt, you can afford a little bit more. So it moves it to 500,000. So see, when I talked earlier about the $23,000 unsecured payment, it actually opens up almost 4 times, a little bit more than 4 times that. So your $400,000 purchase now moves to 500,000. I wonder if he's going to drop that. What do you think? He's really interested. I think he wants to move out of here. Anyway, so that moves to moves the needle up, and you only have to put an extra 20,000 down, so the 80,000 becomes 100,000 in order to keep it at 20% down. Now, I mentioned alternative lending, so these are your B lenders where they can stretch those debt ratios. So interest rates are a little bit higher when it comes to your alternative lending, but it's there's pros and cons for everything. So the pro here is that you can get into a higher property for a slightly higher interest rate. So when we look at the alternative lenders, you're looking at about a $600,000 maximum purchase price with 120,000 or 20% down. So basically, we've got from 315,000 all the way up to $600,000 based on a $75,000 household income. It just depends what you do with that unsecured debt. If you do have that, it might be a good idea to go ahead and pay that off if you want to unlock more purchasing power. So it gives you an idea there, guys. Now keep in mind there are a few things that I did as far as assumptions go. I assumed that there were no condo fees or maintenance fees. It was freehold. I also assumed great credit. And interest rates of qualifying stress tests of 5.25%. What do you guys think? I want to hear your comments below. Have you been able to find something within your price range, or some of the strategies you have used in order to afford, to live where you want to live? Anyway, guys, that's all I've got today. Again, like this video if you found some value in it. Subscribe and share it as well too. I really appreciate it. Okay, I'll talk to you soon.